Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's schedule events for Wednesday, March 2nd. Well, here in Europe, today's indicators start out at 9:30 GMT with the UK Construction PMI for February. The UK Manufacturing PMI unexpectedly fell sharply in February, according to yesterday's data. The Construction PMI is expected to rise, but so too was the Manufacturing PMI. Now, if the Construction PMI unexpectedly declines along with the Manufacturing PMI, that will only add to the pessimism surrounding sterling and will probably be quite negative for the currency. The big indicator of the day is at 13:15 GMT when we get the ADP report for February. This is usually taken to be an indicator of what Friday's non-farm payrolls will be. The market's looking for some fallback after January's relatively high level, although in my view this would simply be mean reversion and wouldn't imply any deterioration in the employment picture in the U.S. On the contrary, an ADP of 188,000, as the market expects, would be pretty robust and could further boost expectations of Fed tightening, thereby boosting the dollar. In any event, the ADP report is an unreliable estimate of the NFP at best. The average difference between the ADP figure and the initial NFP since the beginning of 2005, as shown in this graph here, is 47,000 or 22% of the NFP number. Then at 15:30 GMT, we get the U.S. crude oil inventories for the week ending February 26th. Even though U.S. oil production has been falling recently, inventories continue to rise, which speaks to the size of the production cuts necessary to bring supply into balance with demand. Inventories are expected to rise further in the latest week, too. That could be bad for oil, bad for risk, and therefore bad for the dollar. Finally, overnight, we get the Caixin Market China Services and Composite PMIs for February. The official China Service Sector PMI has declined sharply for 2 months in a row. By contrast, the Caixin Service Sector PMI was up sharply in January. The two are now at about the same level, as you can see here. However, following the unexpected fall in the official manufacturing and non-manufacturing PMIs in February and the Caixin manufacturing PMI, it's quite likely that the Caixin non-manufacturing PMI will fall as well. That's likely to be negative for the yuan and the Australian dollar. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.